Welcome to part 3 in continuation of series related to priority sector lending. Wide RBI Master Directions dated 24th March 2025. In this video, apart from contents of RBI Master Direction of 24th March 2025, certain concepts have been explained for your benefit. To start with, interbank participation certificates, that is IBPCs. An IBPC is a financial instrument where one bank, that is the issuer, borrows monies from another bank, that is the lender, for a short period, promising to return the principal with a specified interest rate. IBPCs are used by banks to manage liquidity and meet regulatory requirements, particularly for meeting priority sector lending targets. Some IBPCs involve the lender sharing the credit risk while the others do not. IBPCs are seen as a way for banks to ensure liquidity in the short term. IBPCs bought by banks on a risk sharing basis are eligible for classification under the respective priority sector categories, provided the underlying assets are eligible to be classified under the respective categories and the banks fulfill the RBI guidelines. IBPCs bought by banks on a risk sharing basis relating to export credit as shall be classified from purchasing bank's perspective for priority sector categorization. However, in such a scenario, the issuing bank shall certify the underlying assets is export credit, in addition to the due diligence required to be undertaken by the issuing and the purchasing banks as per guidelines. The next is Priority Sector Lending Certificates, that is PSLCs. Priority Sector Lending Certificates are tradable instruments issued by banks that exceed their priority sector lending targets, allowing banks with shortfall to meet their obligations by purchasing them. The RBI has issued guidelines on priority sector lending certificates and provides a trading platform for banks to trade these certificates. Priority sector lending certificates are essentially social credits that banks can use to meet their mandated priority sector lending targets, which are set by the RBI. Banks that lend more to priority sectors than required can issue priority sector lending certificates, which can then be traded on a platform like RBI's eKuber. Banks that fall short of their targets can purchase these certificates to fulfill their obligations. The goal of priority sector lending certificates is to promote market efficiency in priority sector lending, incentivize banks to lend to priority sectors, and help banks that struggle to meet their targets. For banks with surplus lending, they can earn additional income by selling priority sector lending certificates. For banks with shortfalls, they can meet their priority sector lending targets without having to increase their lending to priority sectors. For the economy, priority sector lending certificates can help direct credit to priority sectors, which can lead to increased employment, infrastructure development, and overall economic growth. Priority sector lending certificates are short term accounting instruments that expire at the end of the financial year in which they were issued. Bank A, which has exceeded its priority sector lending target, can issue priority sector lending certificates and sell them to Bank B, which is struggling to meet its target. Bank B can then use these priority sector lending certificates to count toward its priority sector lending achievement. Banks are permitted to purchase, sell priority sector lending certificates in terms of RBI guidelines. The net nominal value of the priority sector lending certificates issued and purchased will be eligible for classification under the respective priority sector categories, provided the underlying assets originated by banks are eligible to be classified as priority sector advances. The next one is bank loans to MFIs, that is NBFC, MFIs, societies, trust, etc. for on lending. Loans disbursed by banks to MFIs are eligible for categorization as priority sector advances under respective categories, that is agriculture, MSME, social infrastructure, and others, provided the MFIs adhere to the conditions prescribed. Loans by banks to registered NBFC, MFIs, and others MFI societies, trust, etc., which are members of RBI recognized self-regulatory organization for the sector. For on lending to individuals and also to members of SHGs, JLGs are eligible for categorization as priority sector advances. The next one is bank loans to NBFCs for on lending. Bank credit to registered NBFCs other than MFIs for on lending will be eligible for classification as priority sector lending under the respective categories subject to the following conditions. The first one is agriculture up to rupees 10 lakh per borrower in respect of term lending component under agriculture. The second one is micro and small enterprises up to rupees 20 lakh per borrower provided banks maintain disaggregated data of such loans in the portfolio. The next one is bank loans to housing finance companies for on lending. Bank credit to housing finance companies approved by NHB for on lending for the purpose of purchase, construction, reconstruction of individual dwelling units or for slum clearance and rehabilitation of slum dwellers will be eligible for classification as priority sector lending subject to an aggregate loan limit of rupees 20 lakh per borrower under housing category. Banks shall maintain necessary borrower-wise detail of the underlying portfolio. Next is cap on lending. Bank credit to NBFCs including HFCs for on lending will be eligible for PSL classification up to an overall limit of 5% of individual bank's total priority sector lending of the previous financial year. Next is co-lending by banks and NBFCs to priority sector. Scheduled commercial banks are permitted to co-lend with registered non-banking financial companies, including housing finance companies, for lending to the priority sector as per guidelines. Next, let's understand non-achievement of priority sector targets. All banks reporting shortfall in priority sector lending vis-a-vis the prescribed targets, sub-targets shall be allocated amounts for contribution to the Rural Infrastructure Development Fund and other funds with NABARD, NHB, SIDBI, Mudra Limited as decided by the RBI. While computing priority sector target achievement, shortfall, excess lending for each quarter will be monitored separately. A simple average of all quarters will be arrived at and considered for computation of overall shortfall, excess at the end of the year. The same method will be followed for calculating the achievement of priority sector sub-targets. The interest rates payable to banks for their contribution to RIDF and other funds shall be as follows. Shortfall in overall priority sector lending target, that is less than 5 percentage points, deposit rates, bank rate -2. Shortfall in overall priority sector lending target 5 and above but less than 10 percentage points, deposit rates, bank rate -3. Shortfall in overall priority sector lending target 10 percentage points and above, deposit rates, bank rate -4. Further, in case of no shortfall in overall PSL target but shortfall in any sub-target, interest rate of bank rate -2 percentage points will apply. The misclassification in PSL, if any, identified by the RBI DOS will be adjusted from the PSL achievement of the relevant year, to which the amount of misclassification pertains, and shortfall will be allocated to various funds in the subsequent years. Non-achievement of priority sector targets and sub-targets will be taken into account while granting regulatory clearances, approvals for various purposes. Now, let's understand common guidelines for priority sector loans. Banks shall also comply with the following common guidelines for all categories of priority sector advances. That is, no loan-related and ad hoc service charges, inspection charges shall be levied on priority sector loan up to Rs 50,000. In case of eligible priority sector loans to SHGs, JLGs, this limit will be applicable per member and not to group as a whole. Record shall be maintained by the bank of the date of receipt, sanction, disbursement, rejection with reasons thereof, etc. Banks shall Provide acknowledgement of receipt of applications for priority sector loans. Bank boards shall prescribe the time limit within which the bank communicates its decision in writing to the applicants. Banks shall ensure that loans categorized as priority sector lending are granted for approved purposes and the end use is monitored by putting in place proper internal systems and controls. Each priority sector loan shall be classified only in any one of the 8 identified categories. In this video, we have understood interbank participation certificates, priority sector lending certificates, bank loans to MFIs, NBFCs, MFI societies, trust, etc. for on lending, bank loans to NBFCs for on lending, bank loans to housing finance companies for on lending, cap on lending, co-lending by banks and NBFCs to priority sector, non-achievement of priority sector targets, and common guidelines for priority sector loans. Thank you so much.